Welcome to this video on backtesting a trading strategy. I want to share with you my experience with backtesting, which I have done for, well, I did do for many years. I don't do it anymore, and I'm going to share with you why. So I had very sophisticated software, very high-powered computer system, and I was trained in how to do this. I'd find a few strategies that were viable historically. And then what you do typically is you understand that's curve fitting. So then you take the successful strategies and you apply them to data that is separate from the data you used historically. That's called out-of-sample forward testing. So most of them, when I took them and used them on out-of-sample data, they failed, like 95% of them. So then that last 5%, which is very hard to find, I would then start trading on real live markets in current time, and none of them were successful over the long period of time. Some would work for a little while and then ultimately fail. So why is that? I started to wonder, because I spent a lot of time on that and I was very disappointed. So when I started thinking about it, I realized, there's some real problems with the whole idea of backtesting. Here's the first one. You've seen this legal statement everywhere. Go ahead and fill in, just in your mind, just fill in the end of this sentence. Past performance is no guarantee of what? And you know the end of this. Most people do. We see it everywhere on websites and on documents that people send to us, brokerage firms, software, whatever. Past performance is no guarantee of future results. So we've seen it everywhere. You knew that. That's a problem. If that's a legal statement that all these companies put on their documentation, that means that that's a very significant issue. And it is. In fact, many studies have been done on this. A couple of them I'll mention are in 2014, a Wall Street Journal study found that only about 14% of five-star funds retained their rating 10 years later. So past performance was not indicative of future results. In 2013, a Vanguard study reported that the one stars, and now we're looking at the other end, the Wall Street Journal analyzed the 5 stars, Vanguard studied the 1 stars, and they had the actual greatest excess returns, what they called, when compared against a benchmark. So, wow, what the heck's going on? It's like the total opposite of what you would expect, especially when most people make decisions on funds to buy based on their past performance. Well, to me, what that indicates is there's probably a reversion to the mean. We all know that very few people ever outperform just the benchmark, the S&P 500. And so therefore, if it does outperform for a while, it reverts back to the mean. If it underperforms for a while, reverts back to the mean. So that's one huge problem. Now, what's another one? Another one is that markets change over time. Back when I started trading, which is decades and decades ago, I'd have to call my broker on a rotary phone of all things. My kids don't even know what a rotary phone is anymore. They see it in a museum. But yeah, we had a black and white TV. We certainly didn't have computers. And so there was no direct access. There were no low commissions. Commissions were high. It cost me $50 to get in, $50 to get out. Decimalization wasn't around. There was no mobile devices. Didn't even have a computer. Bottom line was trading was slow and expensive. And therefore, chart patterns trended more. Today, people use all this technology to get in and out of the market real fast, and that creates choppier chart patterns. So the patterns today are different than they were back then. Now that's on the retail side. Now on the professional side, you've got algo trading, you've got high frequency trading, you've got dark pools. So the speed of what's going on here on the retail or on the professional side is even faster. And so again, you get different type of chart patterns than you did in the past. So, okay, that's great. Now that all begs the question, well, dang, what do we do? So the first thing to acknowledge is there are no certainties in the market. Part of the reason we do backtesting is we're looking for some certainty as to what's going to work in the future. And so acknowledge that there's always risk in the market. Back in the days of Jesse Livermore, they used to call it speculation. I still prefer the term speculation to trading because it reminds me that there's always risk in the market. And so here's how I trade. Here are the principles I use. 2 things. Number 1, market logic and mathematical logic. So what do I mean by these? Well, let's take market logic first. So I'm referring to the market profile model, where the market is seen as an auction place. And in an auction place, you're bidding on memorabilia and so forth, art, whatever it might be, and that item, that's going to sell for whatever someone's willing to pay for it. And that's how the markets work too. We've got this global auction place, essentially. But the logic of the market's not always logical. Sometimes people will pay more than many people would think that a piece of art is worth because they have sentimental connection with it. And the same thing happens in the financial markets. So, and we see that with bubbles. We've seen it in the real estate bubble recently. Before that, we saw it in the technology bubble. Before that, we even saw it with tulips, if you go back far enough, tulips of all things. And of course, this is what Alan Greenspan referred to as irrational exuberance. And so the market logic is the logic of, well, logic in quotes, of people. And psychological studies have shown that people generally, even though we don't admit it to ourselves, we generally make decisions based on emotion and justify them with logic. And so the market logic is not individual psychology, but mass psychology. That plays a major role in how markets move. So the second part of the logic equation then is the mathematical. And you've got to include this too, because over half of the shares on the New York Stock Exchange aren't traded by human beings. Well, I should say they aren't. The trading decisions are made by computer models. And some of these don't really affect you when you are trading, and you certainly can't compete against them. You and I cannot compete against these. You're not going to get a Forex robot off the internet for $19 that's going to compare with mobile, Goldman Sachs or Merrill or Bank of America. So here's what I do. I combine these two types of logic. And the bottom line is that I'm mathematically measuring what the market participants are doing now. So again, remember, it's market participants globally. And I'm taking a trade now. I need to know what's going on in the market right at the second that I'm entering the trade. Not what happened, 6 months ago, 12 months ago, 40 years ago. I trade in the present, bar by bar, and manage my risk. And then I use indicators to objectively and mathematically measure the money flow in and out of the market. Now, that's what we're looking for, the money flow. But money doesn't lie. When people are making commitments and they're actually entering their money, then that's what we want to measure. And I use indicators for that. Now, indicators don't make me money directly. Indicators, if they made us money, we call them money makers. So what is an indicator? Well, an indicator is really just a mathematical equation. I mean, that's literally what it is. So that's why I use them. And I use them to give me an objective value of 5 non-correlated energies to provide a probability scenario. So think of it this way, as 5 variables that when they all agree, that puts the odds on your side. Again, it's not a certainty, but it puts the odds on your side that over a large sample of data, you're going to come out ahead. But the operative key is there that they have to be non-correlated. And again, when I'm talking about energies, I'm talking about the energy of money flowing. So, for example, trend, that's an energy. Momentum, that's an energy. The timing of a high or low, that's an energy. Support resistance, these are the kind of things that I'm talking about. But I use indicators because I don't want to just look at the chart and eyeball it and say, oh, okay, yeah, the trend is up. That is a subjective evaluation. So I only use the indicators to give me an actual number, an objective value for each one of those energies so that I can then objectively create rules for my trading. In fact, happy to share one of these with you. I have a fantastic cycle indicator that I use. This is one of the best things I've ever come up with, and I'm happy to share it with you absolutely free. This gives you the mathematical logic of timing your entries and exits with amazing precision and accuracy, and it's one of the best things that I've ever come up with. I'm happy to share it with you. I do it on a webinar, so I set it up on your charts for you, and then we also show you how to trade it. Just send me an email, barry@topdogtrading.com, and we'll get all the information over to you about the free webinar for that. No obligation, and once you go through that presentation, you'll have it, and you can even integrate it with your current methodology if you'd like. So I know this is a controversial topic today. I've never been one to shy away from controversy. So feel free to participate, whether you agree or disagree or you have questions. Enter your thoughts on this topic in the comment section below. And if you like the video, click the thumbs up icon and especially share it with others. And I'm going to also give you another free offer, and that's my complete trade setup called the rubber band trade. And you can get that by just clicking on the little I that has a little circle around it in the top right corner of this video. Once you do that, I'll send you the information about the rubber band trade, and it's all in one video. It's about 20 minutes long, and that's a complete trading plan that includes the market logic, the mathematical logic, everything. Again, my gift to you.